how do you feel about taking chances? When you invest money, you're taking on some financial risk, and some investments are riskier than others. Generally, low-risk investments are safer because they produce consistent, dependable returns, and many are guaranteed by the U.S. government. For example, with a savings bond, you buy it at a fixed rate of return for a fixed period of time. You're guaranteed to receive a specified amount of interest, along with the purchase price or principal when the bond matures. Medium-risk investments provide a stable return but still allow for capital appreciation or gains. Not as easy to predict as low-risk types, these investments are considered still relatively safe. A mutual fund, which is made up of several stocks, is an example. If one stock performs poorly, the others may keep the fund from failing altogether. High-risk investments can just as easily generate big losses as big returns. For example, a single stock's price could climb today, but could fall tomorrow. The market can be volatile, so whether the stock makes money or loses it is unpredictable. That's why you should research high-risk investments very carefully and reserve them only for money you could lose without any serious consequences. Some investments may fall into either medium or high-risk categories. In real estate, for example, a lot can depend on where investors buy property and in which market. And a mutual fund made up of speculative stocks can be riskier than one with stocks from large, established companies. In short, it pays to do your homework on all your investment choices. Looking at a company's financial statements and reading news articles and analyst opinions about the organization are good places to start. Whatever risk level you choose, your goal will always be increasing the amount of money you've invested. That's called the return on your investment, or ROI. Investors look at the ROI to understand an investment's performance and choose whether to keep it and how much risk to take. Let's say that last year you bought 100 shares of a stock at $100 each. Having a very profitable year, the company decided to pay you and other shareholders a portion of the profits, or a dividend, of $5 per share. The stock price also increased to $110 per share since you bought it a year ago. To calculate the ROI, simply divide the income earned on the investment by the amount originally invested. Since your stock increased by $500 in dividends and $1,000 in capital gains, it earned a 15% ROI, which is pretty good. When making investments, a lot depends on how much risk you're comfortable with, and that risk tolerance is affected by your financial goals, how much money you actually have to invest, and the amount of time you plan to keep your money invested, also called your time horizon. Consider this. If a young couple in their 20s is saving for retirement, most experts would encourage them to take more risk. Maybe they could purchase more stocks than bonds because they have many decades to endure the volatility of the market before they need to sell. However, for an older investor a year away from retirement, the same experts would advise to minimize risk, for example, buying more bonds than stocks. The greater the risk, the higher the potential for reward, and the higher potential for loss. Investors are always faced with a trade-off. Choose low-risk investments that provide financial security and safety but offer low yields or returns, or choose high-risk investments that may offer high growth and returns but can also result in major losses. But most financial experts will advise diversifying or mixing it up a little. When your portfolio includes a range of investment types, the more likely you'll have relatively stable, profitable investments. Whatever you do, look before you leap. Do your research to make sure you're choosing the investments that best match your risk tolerance and your financial goals.